Good day, traders, and welcome to another episode of Crypto Vibes with Walt. Now, I wasn't planning to do this today, but obviously, we had some key data coming out yesterday, and today we have the CPI print, so I thought that I should put my thoughts across to better prepare you all for the markets. Now, I want to talk about two key factors from a macroeconomic standpoint that I think could affect the Fed's decision in the future. And then we'll delve into some of the charts. But before we do that, here's a snippet from previous week's episode. So maybe we see a rally somewhere around here, and obviously we have an untested high. Sweep that high, get back below. This forms a deviation, and then we see that aggressive sell-off. Now, I don't know what else to tell you guys. So this was the key level that I was watching on the previous episode. And look what price did. It retested it on multiple occasions before an aggressive sell-off. So if you'd have tuned in the previous episode, there was an easy 3R to be made just on the downside 3 times, right? So price retested it once, twice, and on the second occasion. So just on the downside, there was a 3R trade to be made on multiple occasions, right? If that's not accuracy, I'm not really sure what else is. So make sure that you subscribe to the channel and hit that like button so that you don't miss out on such updates. Now, it's very hard to find anything positive right now, and I don't want to be a pessimist. I want prices to go up because when prices go up, we all make money, right? But right now, I can only translate the facts that I have in front of me. Now, as you all know, that the Fed wants to slay the inflation dragon, and as long as the Fed wants to fight inflation, it's fine. But as soon as there is a hint of financial instability, they can't continue that fight because financial instability is a much more dangerous risk to the economy and to the outcome of inflation, which then turns to deflation if you have a credit-related financial event in the market. Now, there are numerous things that are piling up that suggest that the risk of a financial credit-related event will occur in the market sooner rather than later. The key main topic of discussion last couple of weeks have been, firstly, the Bank of England pivot. Now, I don't want to go into a lot of details about it because that'll eat up a lot of time, but the Bank of England had to bail out a highly leveraged pension funds market because they borrow collateral at a very low interest rates, and as the asset prices come down, they're forced to sell to meet those margin calls. So to make sure that they don't get insolvent, the Bank of England then had to stop quantitative tightening and implement quantitative easing. Now, the US is similar to the UK, but on a very large scale. So the question still remains, how long can the Fed continue to tighten the economy before something breaks in the markets? Now, the second thing that I wanted to cover was the PPI numbers that released yesterday. The producer price index measures the change in the prices of goods sold by the manufacturers, and it is a leading indicator of consumer price inflation, which is the CPI that's releasing later today. And this kind of accounts for majority of the inflation. Now, if you look at what the numbers tell us, the forecast was 0.2 and it came in higher than the forecast, which was 0.4. This is the month on month, and on the year on year also was quite higher than what was expected. Now, this is happening, in my opinion, mainly because of two main reasons. First is either there is still demand in the markets, and secondly, there is a supply shock. Now, if you look at some of the employment numbers that released last week, so the unemployment rate is 3.5%, which is less than what was forecasted, and still, if you look at the non-farm payrolls, it's higher than what was forecasted. So that means that there are jobs in the market, and there are less people who are unemployed, which means that the demand won't be suppressed anytime soon, and that then gives Fed another opportunity to continue tightening the economy even further. So these are the couple of things that I wanted to cover, which were really important in terms of what the Fed might do in November's FOMC. Now let's look at what the charts are doing. Now if you look at the dollar, it's clearly in a very aggressively trending environment since last year, right? So in my opinion, it is going for, I think, these highs next, which is somewhere around the 120 to the 121 region. And the reaction that we get at these highs would then define the price action in the risk assets for the next coming few weeks. Now, either we'll sweep these highs, close back below, and then sell off in the dollar index, or we'll reclaim these highs, form this as a support, and then continue rally higher. Either way, we'll talk about it when price reaches these levels, but this kind of correlates perfectly with what we are expecting the risk assets to do. And we'll cover that a bit later. But if you look at the weekly as well, the tips are aggressively being bought on the dollar, which kind of gives an indication that the momentum is still to the upside, and it is going as for those highs around the 120 region I just mentioned. Now for the dollar index to form some sort of a topping pattern, what I am expecting it to do is, again, this is the key region that I'm expecting price to be at. So maybe if the dollar can push higher, correct a bit, then another rally higher, sweeping out all these highs, another rally, and then the third drive higher, which then stops out all the traders who are short at this level, and then the dollar starts to break down. So this is a very good this would be a very good indication that the dollar wants to move higher now, and that the rally is coming to an end. Something similar happened over here. If you look at the price action in this region, there was an aggressive bull market in the dollar. Price corrected, a weaker bounce before price corrected again, and then the third drive higher, which swept all these highs, and then the dollar really broke down. We saw something similar around this region as well. Again, key highs, price was in an aggressive bull trend, correction, a weaker bounce, then another correction, and then a third drive higher to stop out all these traders, and then look at the sell-off in the dollar index. So something similar is what I'm expecting at this region, and then it also correlates perfectly with the S&P, because if you look at the equities market or the S&P market, it is in an aggressively downward trending environment, where the resistance are getting respected on each level, and the supports are getting broken. So that's why, in my opinion, I think that there is possibly like a 10% more drop left on the S&P. And again, if you look at the extreme high time frames, how has the bottoming formed? So again, I do expect another 10% drop on the S&P, which then perfectly correlates with the dollar moving higher towards its 120 region, and then we can see a trend reversal on both of these pairs. Now, if you look at historical data, again, this was a key level of SR. Price consolidated at this level, broke market structure, retested it, and then rallied higher. So if we could just form a range around this level, consolidate, or form an accumulation pattern, break market structure, reclaim these highs, then I think that would be a really good indication that the market really want to push higher from here. Something similar again happened in this region as well, Price consolidated for a long period of time before it broke market structure and then an aggressive rally higher. So if we could again form a sort of a range or sweep these lows and then close back above, any break of market structure would then give a very clear indication that that is a bottom on equities or on risk assets, and the markets really want to push higher from there. Again, this also correlates with Bitcoin as well, because if you look at how much price has moved down on the S&P, it has moved down somewhere around 26%, right? And if you look at Bitcoin from the highs has moved down around 74%, so approximately 3 times more than what the traditional markets have done, right? So if there's still a 10 to 12% drop on the equities or S&P, then that correlates perfectly with the bottom, with this this weekly support level that I've marked for quite some time now. So it's simple maths, guys, right? A 10 to 12 to 15% drop on the S&P, 3 times more drop on the beta assets such as Bitcoin and Ethereum. So again, perfectly correlates with how the dollar is performing, how we expect the S&P to perform, and then what Bitcoin will do. So this is something to keep an eye on. Now, if you look at Bitcoin from a macro perspective, all we see is a range-bound environment for the past few months where price has simply consolidated or moved sideways and stopped out traders on either sides before we get that actual move to either the downside or the upside. So I feel that because we have the CPI numbers coming out, that we're very close to seeing the volatility kick back in now, as we also have some crucial macro economic events unfolding in the next few weeks as well, and the probability of risk being skewed to the downside is very high in my opinion. Now, even if we look at last couple of weeks candles, the rallies, any rally higher has been aggressively sold off. So it kind of gives a very clear indication that draw on liquidity is definitely to the downside, guys, right? So this is also you need to keep in mind. Now, from a very simple technical standpoint, if this is a level that's capping price and the compression is increasing at this level, so how long will it be before this level gives way is the question that I'm asking myself now. We've already had more than 5 retests of this level, and in my opinion, if price is retesting this level again at a crucial date where we have the CPI numbers coming out, so now I'm siding towards the fact that this gives way and price breaks down towards the high time frame levels, which is around the 15,000 level of support next. Now, obviously not a lot to cover right now because price is at a key level of resistance or of support. If you look at the weekly, again, I've highlighted this on multiple occasions as to why this level is important. Now it seems that price is finally breaking down from this level, so I would be anticipating a move down towards this level of support first, which is this consolidation before we saw the expansion higher. Price could find some sort of a support at this region before it breaks down further towards the 10,000 region. So I'm already positioned in some of the shorts already, and I won't be looking to position myself right now before I see what price wants to do once the CPI numbers come out, because obviously price is now front running. The markets are front running the news based events. So either this is an instance wherein the markets have anticipated a higher CPI because obviously we had the PPI numbers released yesterday, and I already explained why that was important. So either this is just a preview of what is to happen once the CPI numbers are coming out, or markets are front running the event, and once we have the CPI numbers come out, price will rally high to trap all those shorts who would so a lot of people would short once the CPI comes in hot, and this rally would then stop all these traders out. So I'd be anticipating these highs to be taken next if that happens. If we consider this as a range, right? So now we have already swept the range highs. So the next drawn liquidity is most likely this range low. So again, this is a possibility that I'm watching, that price now sweeps these range lows, reclaims above, and then it rallies higher towards the range highs. And this to me will be an aggressive short scenario if price rallies towards the range highs, sweeps these range highs, closes back below. That is when I will be aggressively positioning myself on shorts, because that will be an indication for me that price now wants to break down. And obviously I don't really expect this level to hold right now, but this is just one of the scenarios in case price deviates below and close backs above, rallies towards extreme end of the other range. And if then this is a false breakout and price close back below, that is a very good indication that next time when price revisits this zone, this is going to break and we'll see lower prices. Again, from a price action standpoint, nothing much happening on Ethereum. As I covered previously, this was a key level of resistance because we have the daily supply as well as a key pivot along with the range low, which was like a very strong level of resistance. Price tried to break higher, was unsuccessful in doing so, and now it's starting to break down. So again, on just a very macro perspective, I am expecting the weekly level of demand to be tagged on Ethereum next if we continue to sell off, which is somewhere around the 1000 to the 1200 region, somewhere around here. So again, confluent with what we expect Bitcoin to do, and if it forms a base somewhere around this region, then that's a very good indication that price is in an accumulation and then we can see a rally towards this level of key resistance next. So that is all that I'm watching on the markets right now. Not a time to get aggressively positioning yourself into trades as we have some key macro events unfolding. So hope you guys found this insightful, and hit that like button, subscribe to the channel to show your support, and I'll talk to you guys soon. Cheers.